It turned overlooked stocks into five-figure gains. And today, we're breaking down Abercrombie and Fitch using my three-step system that tells me when a stock is undervalued before the crowd sees it. This is how you build generational wealth. Let's break it down. Abercrombie and Fitch ticker symbol is ANF. Current stock price is 129, and this is going to be Q4 2025 analysis data. Current portfolio update, ROI sitting at 103%. We are killing the game. And I show you how to do it right here. Can't get any better than that. Alright, so step one, I'm checking market mood. I have a quote here: be fearful when others are greedy and greedy when others are fearful. And this is going to be explained deeper into this PowerPoint and analysis. But this is what I live by when I buy. I want the market to be in fear. I want the market to be in fear. I want instability. And that is when I'm looking to buy every single time. First thing I'm checking is the Fear and Greed Index. You can find this on CNN.com or just Google it. And it's going to be this little meter that you see here. And it's going to give you a number. And that's going to be where the market mood is sitting currently. And when I bought this stock, we were sitting at 53. So we're in neutral territory. I want to see it in fear. The VIX is the volatility index, so this is basically telling you the volatility of the market. Like I said, I love instability, so I want high volatility. I want that market up and down, shooting any which way, really. But I checked this. The value when I bought this stock was 15, so that's low volatility. That's calm markets. It's not the best. And lastly, I look at the put/call ratio, which is determining how many puts are being bought and how many calls are being bought. And puts would be people are betting markets are going down. Call would be people are betting markets are going up. And like I said, I want instability. So I'm looking for the put-to-call ratio to be high, meaning people think that market is going down. Why do I like this? Because that means people are selling and the price is getting discounted, so I'm buying at a discount. People are selling their assets at a discount, and guess who wants to step in and buy? Me, and hopefully you too. So what was that value when I bought? 0.58. Again, it's not what I am looking for. So what does this all mean? Well, I put it in together. I created this proprietary formula for myself so I could put the numbers and create some type of English meaning to it. And I bought this stock twice. The very first time are the numbers I just showed you, which was on September 28th. And what I said was these were like more so neutral numbers. So my signal that I got from my formula was to DCA at key levels. So what does that mean for me? I'm dollar cost averaging in. So as the market is going down, I'm buying little by little. So why does this matter? Because again, like I said, I bought in twice because DCA is continuously buying as you go down. I bought again in November, and as you can see with these different numbers, it was a strong buy. So why do I care about the signal if it's going to be DCA, strong buy, or regular buy? Well, that risk percentage is why I care. When it was a strong buy, I want to put more of my capital into it. So I'm risking 3% of my capital versus at a DCA when things are neutral, I'm only risking 1%. And why is that? Well, let's put it into simple terms. Let's use shopping. If I go to my favorite store and on September 28th, my favorite sweatshirt was only 10% off, yeah, it's a nice little discount. But do I really want to go and put all my life savings into that sweatshirt? Not really. It's not big enough discount. I might get one. Now, if I come back in November 14th and it's on 75%, hey, guess what? I'm buying more than just one sweatshirt that time. So that is why these signals matter, because it calculates how much risk I'm willing to put into these positions. All right, step 2, we're analyzing the fundamentals. Earnings per share. This is telling us how many earnings per share of a company. So I want to see this above 4. ANF earnings per share is 10.9. This is excellent. Earnings per share, 3-year average growth rate. I want to see this above 15. It's basically just telling me, is my earnings per share growing year over year? Which I want to see growth in all metrics. 163%. I'm not going to look at that exact value, but I'm looking at, is it greater than 50%? We're good to go. And I'm also going to explain this with math. Why do we care about this? So, example, if company A has earnings per share of $5 and company B has earnings per share of $1, and I own 10 shares of company A and B, which company is making me more as an investor? Which company looks better to me as an investor based on these numbers? Well, simple math tells us what? $50 for company A, $10 for company B. I like company A better. This is why we care about the earnings per share. Shares outstanding is the number of shares issued from a company, and we want to see this decreasing, and I will explain this with math in a second, but the direction of this stock is decreasing. Strong. I love it. Why do we want it decreasing? Let's explain it with math once more. So we have a company with 1,000 shares, and I own 10 shares of that. I own only 1% of that piece of pie. Now, let's say the company does a buyback, right? So now they only have 100 shares, but I kept my 10 shares. Now I own 10% of that piece of pie. 10% is way bigger than 1%. And that is why we want to see the shares outstanding decreasing. Because that means the shares that we're keeping in our pocket, in our portfolio, are just getting more and more valuable. And the number of shares is 47.1 million, and we'll get back to that later when we calculate where I want to buy. Okay? Revenue. Revenue is just equated to profits, like any other business, right? Your profit. 5.2 billion. Looks good. Where we really want to pay attention is 3-year average growth rate. Once again, this is just a average of how much it's growing year over year, 3 years, average over 3 years. Okay? I want to see this above 10%. And we are at 12%. We are strong. I'm loving it. Free cash flow. Free cash flow is basically what you have left to spend. So let's put it into everyday, simple terms. You get a paycheck from your company. Scratch that. Start over. You get paid. You have a base hourly pay from your company. And before you even get that direct deposit, you got taxes. Boom. Taxes are coming out. Boom. You get the direct deposit. But let's not stop there. Now we have our mortgage, our rent, our car note, our groceries, our whatever. That gets paid. And now we're left with our base. Whatever is in our bank account after all these deductions, that is our free cash flow, right? Equivalent to a company's free cash flow. After all those mandatory things are paid off, what do we have left to work with? What do we have left to invest in? Abercrombie Fitch has $345 million. Now we're looking at the average growth rate. We want to see growth. I want to see this above 10%. We're at 12% again. Looks good. Free cash flow margin is basically just free cash flow, what I just explained, but within a margined percentage. It's basically just putting it into a percentage. So I want to see that above 15%, which would be 15 cents on the dollar is how much cash flow I want to see. They're at 7%. That is neutral. It's not horrible, but it's not great. Price to earnings ratio, PE ratio. This is basically telling us where a company stands with other companies in this industry, as in, are we overpaying or are we not? This is a specific metric that is telling us this. I don't use this to determine whether or not I buy, but I do look at the numbers, because some of them are extremely just through the roof, right? If I ever review a company, I will point that out. But typically, it's not extremely important to me. But what we want to see is ANF under the industry PE. So if the industry PE, if we have the same exact pair of jeans, because we're talking about ANF, every single ANF competitor is selling that pair of jeans for 50, but ANF is selling that pair for 20, obviously we're going to ANF, right? Same type of concept. So the industry PE is 17. We want ANF to be under that, and ANF is at 12. Perfect. We're under industry average. And last but not least, debt. Company debt, same as human debt, real debt. And ANF has 0 debt right now, which is amazing. So what is the debt to free cash flow? Which would be how long it would take to pay off that debt. Well, they don't have any debt, so 0 years. I'm loving that. I'm loving that. All right. I like what I see. Right, I like what I see. I didn't see any weeks. Didn't see any reds. That's when it's just automatically off the list. I like what I see. Now let's check the evaluation. Let's see if this company is in my box, my window, I will buy you at this price window. And what we do for that, or what I do for that, is intrinsic value. So I calculate it using the DCF model, which is basically taking our free cash flow, which I mentioned, our free cash flow numbers, and we're projecting and determining if that company's stock is matching the company financials and fundamentals. Okay? So basically you have to do calculations for this. You can do these yourself. So first you're going to do the free cash flow evaluation. Here's all the numbers. I'm going to just go through the value real quick. If you want to do it at home, you can do that. So free cash flow is just a financial. You can get that from the company financials, $345 million. I talked about that already. Margin of safety. This is basically giving myself a buffer. I have 3 different levels of margin of safeties. Again, I'll get into that later. But basically, we have target 1, target 2, target 3. 60% is target 1, a 60% buffer. 3-year average growth rate, 7%. Some of the platforms allow you to take into account of inflation, so that's where 7% is coming from. But you can just use the free cash flow 3-year average growth rate number. Discount is 8 to 10% is the standard. Terminal growth rate 3% is standard, and shares outstanding 47.1 million, which we talked about earlier as well. And here are the calculations. I color coded them for you and everything. You can follow along and you can plug them in for any stock you want. You're gonna do terminal value calculations, and then lastly but not least, you're gonna calculate the intrinsic value. You add those together, and finally we get our intrinsic value, which is dividing the equity value divided by shares outstanding, and we get $126 per share is what this stock is worth. Now, earlier on in the very first slide, I think I said it was 129. Yeah, so right now it'd be overvalued according to these numbers. But like I said, I bought in September and November. But there are other targets, so let's talk about it. Let's talk about my position. So my buy zones are the same, universal. I'm buying at the weekly 200 and 400 moving average or the daily. I'm buying at the 200, 400 no matter what. Okay? So my entry for this stock specifically, I bought in this red area. This is actually equivalent to the 200 weekly moving average, but this is the daily time frame, so you can't see that. And I also bought this candlestick off the 200 daily moving average. And I averaged at this white line $82 per share. And like we said, it was worth 126, right? So I already hit my first target. I actually hit it today for a profit. I was up $4,000. I was up 4,000 and 4,500. But we have multiple targets. So that was my 60% margin that I hit that target. First target was hit, conservative intrinsic value at 130, which was a 60% ROI. And my next target would be at 140, which is the neutral intrinsic value. So that would be a safety margin of 40%. Yes, 40% safety margin. So this is my next target. So technically, if you wanted to, because right now the stock is at 129, 130. Technically, if you wanted to, you could get in right now, but I don't buy in when it's this high above the 200 moving average. That's just me. But I do have another target coming up, and that would be for a 70% ROI. Now, I do have a JLaley Indicator. It is currently not for sale yet, but you can get on the waiting list on my website, JLaley.com. And what it does is all this I just showed you manually, it does it automatically for you. So candlesticks will be colored. Let's go back to this. Candlesticks will be colored green if it's good to go financially. And it will also automatically chart and plot the 3 intrinsic value target levels with all margin of safeties. So you got your conservative, which is 60% margin of safety, your yellow line, which is neutral, 40%, and last but not least, aggressive, 10%. So if you want to get on the wait list for that, it's on the website. And if you enjoyed this breakdown and want to see another breakdown, make sure to like and subscribe. Thanks for watching.